How to invest your first $1,000 as a millennial. Buy a bunch of Bitcoin. I mean, I don't really think there's another option. Just invest really as much money as you can, get in as quick as you can. You'd be pretty silly not to do that. So thank you guys for watching, and I'll see you in my next video. Alright, I am just joking with you guys. Hello and welcome to the video. My name is Brandon, and I really am excited for today's video. I'm going to be going over how to invest your first $1,000 as a millennial. Because for so many people, man, they just don't have the first idea of where to start. You can look at investing and it can be such a daunting field. And that is completely understandable. So in this video, I'm going to be going over step by step how to invest your first $1,000. Now, as you can see from the title of this video, I chose, how to invest your first $1,000 as a millennial. That is just a number, all right? You absolutely do not need $1,000 to start investing. You can start with $100. You can start with $10,000. The concepts and the principles are going to be the same. I just thought that 1,000 would be a great number to start with. Also, an important thing to note here is that this video is catered towards millennials. And that's really important because the way that a 40-year-old would invest is very different than how a 20-year-old would invest. They're at completely different stages in their investing careers. They have completely different goals, completely different objectives, and their portfolios would reflect that. As a young investor or as a millennial, we should absolutely be concerned with growing our wealth, accumulating shares, and ultimately, building up a base for our financial future. And I say this very lightly, take it with a grain of salt, but theoretically, as a younger investor, we should be able to take on a higher level of risk with the expectation that we would receive a higher rate of return. And this is because as millennials, we have such a long investing career ahead of us. I mean, we literally have decades and decades to invest, or what we would call our time horizon. And where this is advantageous to us is that, when the markets go down or when they dip or when there's a crash, we have many years to outlive those crashes and allow our investments to recover. Whereas someone who is, maybe in their 40s or 50s, sorry, I should say maybe like 50s or 60s, they may not have that luxury, right? They may be at the point where they need to start drawing income from their portfolio. So they have to be a little more conservative with their investments. So like I said, this video is going to be catered to how a millennial should be invested and how a millennial should structure their portfolio. So before I get into this video, let's just go over what I'm going to be covering. So these are the steps that you're going to need to go through to get set up for investing. So step number one, choosing your broker, and we'll talk about this in a second. The next step is to choose the account type that you want to open. So when you want to invest, you have to open up an investment account. There's some different options. We'll go over those. Step number three is setting your asset allocation. We'll touch on that. Step number four is actually choosing your investments. We'll choose here the investments that you're going to be buying, and this will be based off of your asset allocation. Step number five, sit back and relax. I'm just joking. I mean, you will sit back and you will relax, but there are some follow-up things that you will need to do as well to make sure that you are, keeping up to date with your portfolio. So let's not waste any time and let's get right into the first section. I hope you guys enjoyed the video. If you want to learn more about investing, you can subscribe to my YouTube channel. Let's go. So step number one, choosing your broker. So what is a broker? Well, a broker or a brokerage essentially is where you'll be hosting your investment account at. So I can give you a little analogy here. It's similar to like if you wanted to go buy a house, you can go to Remax, you can go to Century 21. They're kind of like the intermediary, right? That's kind of what a brokerage is like. It's just where you're going to host your investment account, if that makes any sense. Now, as for choosing your broker, you really have two options. So you can go the traditional route, which is going in person to somewhere like your bank or to an investment firm. And with this option, you're going to get linked up with an investment advisor or a financial advisor. So they'd be there to help you set up your account, help choose your investments, that type of thing. Some of the typical investment firms that you could go to are Manulife Securities, Raymond James, Edward Jones. They're all kind of equivalents of each other. Or you could go to your local bank. And wherever you decide to go, well, that's where you're going to host your investment account. So if you decide to go to Edward Jones, well, you're going to have an Edward Jones investment account. If you decide to go to TD, you're going to have a TD investment account. So that is your first option, go in person. Now, the second option that you have, which is very popular amongst millennials, is using an online broker, or what people would call a discount broker. And with this option, you can invest from the comfort of your home, right? You can invest from your laptop, or you can use your phone, right? You can invest by using an app. And with this option, you would not have an investment advisor. And that's actually where they get the term discount broker, because you're not paying for any advice. You're not paying for any professional advice. All the investment decisions are left up to you. You're pretty much completely on your own. So if you do know exactly what investments you want to buy, this may be a viable option. Now, personally, my recommendation as to which is the best platform if you do decide to go for this online route is likely going to be Questrade. So I live here in Canada. If you're from the States, I've heard Robinhood is a pretty good platform as well, but I don't know enough to make a recommendation there. But as for Canadians, yes, I do think Questrade is probably going to be your best option. I'll put a link down in the description below, but after kind of looking into the different options, I kind of narrowed down to Questrade and TD Direct Investing. Those were the top two for me. But after comparing costs and commissions and account minimums, I think Questrade is probably going to be your best bet. And why do I say that? Well, to me, Questrade has very reasonable commissions. So when you want to go buy and sell a stock, you have to pay a little commission up front, right? You got to pay a bit. And Questrade is on the lower end of the spectrum. It's as low as $4.95 per transaction. A lot of other brokers you'll see like $9.99 or $14.99 and upwards. So very reasonable. But more importantly, one of the main reasons why I think Questrade is a great platform is because they offer ETF purchases at no cost. And this is huge. I mean, normally you'd pay a commission to purchase an ETF. With Questrade, though, one of their selling points is that you can purchase ETFs for free, which is very, very good. And if you don't know what an ETF is, don't worry, that is completely fine. Later in the video, we're going to go over ETFs because they're an investment product that you very well may end up using. So of these two options, which one is better? Going in person or going the online route? Personally, I would recommend to you go in person and go set up an appointment with an advisor. I'm a huge advocate of working with an advisor. I think that they bring a lot of value. They are professionals in this space. They'll obviously help you with setting up your accounts, choosing your investments, but more importantly, they're there for that, that emotional support. And if you have questions, you can bounce them back and forth. They'll make sure that you don't make any big mistakes. And like I said, it's just kind of like that second layer of support that could be very, very useful. And there's a reason why statistically, investors that work with advisors do better than ones who don't. So that's a fact, yeah. But using an online broker is a good choice too. There isn't a right or wrong, but my recommendation to you, go in person, try and find an advisor that you can see yourself working with for the foreseeable future. Try to build a good relationship there. Okay, so let's move on to step number 2, choosing your investment account. All right, so once you've chosen your broker, the next step is to open up an investment account. And an investment account is very similar to a bank account, except for with an investment account, you are eligible to hold stocks, bonds, ETFs, mutual funds, pretty much any type of investment within the investment account, which is something that you can't do in your bank account. And let me show you an example here, maybe for someone that's very new, by using a couple of mugs. So this mug right here is your bank account, all right? Like your checking account or your savings account. So it's got some money in there. Hopefully, maybe your bank account looks more like this, but let's just assume that you got some money in there. Then what you have to do is open up a separate investment account. And again, this is going to be at your brokerage. So you very well may have a TD bank account or a Coast Capital bank account, and you may have an Edward Jones investment account. That's completely fine. They're two separate accounts. And then once you've opened up your investment account, you basically transfer money in, or you can deposit money. And once the money is then in your investment account, you can then go ahead and buy stocks, bonds, mutual funds, pretty much whatever investment you want within that investment account. Now, this is where things may get a little confusing, but when you want to open up an investment account, you have a few options. There's a few different types of accounts, but the two most common accounts that you can open are the RRSP, so the Registered Retirement Savings Plan, and the TFSA, the Tax-Free Savings Account. And these two accounts have slightly different characteristics. And I apologize for the likes of this video. I'm not going to go into detail comparing the RSP and the TFSA. It would just take way too long. But I do have a video that is completely dedicated to that. It goes through the pros and cons of each, which one is the most appropriate for your situation. It's a really good beginner walkthrough video, and I will link that in the description below. So you should definitely go check that out. It's only about 10 minutes. But for the likes of this video, I'm gonna recommend that you go with the TFSA, the tax-free savings account. This is a great account for a beginner. You're gonna have a lot of flexibility with putting money in and taking money out. There's not really any big tax complications. Whereas with an RSP, there's definitely some things that you have to factor in. With the TFSA, it really is just an account where you can put money in, buy some investments, let them grow tax-free. You can make withdrawals, you can take money out whenever you want. It really just is a really good tax-free account. Like I said, very flexible and a great account for a beginner. And if that didn't make any sense to you, just go watch the video that I'll link in the description. That'll make things a whole lot clearer. But you'll just have to trust me, go with the TFSA. All right, so those were the boring parts. Setting up your account, picking your broker, that's super boring. Now we actually move on to the investment side. So step number 3, this is where it gets fun, setting your asset allocation. So at this point, let's recap here. You've chosen your broker, you've set up your investment account. Let's assume that you've decided to go with the TFSA. Let's assume here that you funded your account, right? So you now have $1,000 sitting in cash in your TFSA. Well, the first real decision that you have to make as an investor is how you want your money to be invested, all right? Kind of like the guidelines or the targets as to how your money will be invested. Now, if you haven't seen my video on asset allocation, you should check that out as well. I'll link that below. Very good beginner walkthrough. But essentially, when you want to invest, there's really 2 types of assets that you can buy, all right? You have stocks, and then you have bonds. And a lot of people tend to think that they're the same thing, right? Because you always hear it in a sentence together, right? Hey, stocks and bonds. Hey, how's stocks and bonds doing? They're actually 2 very different assets with 2 very different characteristics. So when we invest in stocks, we are buying shares of companies, all right? Coca-Cola, McDonald's, Tesla. When we're investing in these companies, we would expect to see growth. There's a lot of potential to make money, but with that would come a higher level of volatility. Whereas when we invest in bonds, essentially what we're doing is we are lending out our money, right? We're taking our money, we're lending it out to a company or to a government, and we're receiving an interest rate in return. So with a bond, this would definitely be considered a more conservative investment. You would be receiving a steady stream of income from the company or from the government, but you really wouldn't be expecting a whole lot of growth. Now, typically what people would do is that they'd have a combination of both. They'd have a mixture of some stocks and some bonds. So essentially what your asset allocation tells you is it tells you of your $1,000 or whatever your investment amount is, how much is going to be allocated to investing in stocks and how much is going to be allocated to investing in bonds. Now, a very common asset allocation mix that you'll come across is the 60-40 split, all right? Meaning that 60% of your money, in this case $600, is going to be invested in stocks, and then 40% of your money is going to be invested in bonds, right? So $400. Now, this would be considered a very well-balanced portfolio, right? You got a good portion of it invested in stocks, which is going to be the growth component, and you got a good healthy dose of bonds, right? So the conservative safety part. And like I said, this would be considered a very well-balanced portfolio for someone that's a little bit older. However, as the title of this video states, this is investing for millennials, not old people. And as I touched on earlier, because we have such a long time horizon, we absolutely should be taking advantage of that and essentially striving for more growth. Or in other words, taking on a slightly higher level of risk. And that is why for a millennial, I would absolutely consider going with an 80-20 split, meaning that 80% of our money should be invested in equities and 20% should be invested in fixed income. Now, this would absolutely be classified as a growth-oriented portfolio, and that's exactly how it should be, right? The higher weighting we have to equities or stocks, the higher return we would expect over the long term. And as an asset class, stocks will always outperform bonds. There will be periods of time where this isn't the case, but stocks, or equities I should say, that's where the growth is at. And that's why, as for millennials, that's where a majority of our money should be invested. Now, you will run into people that make the argument that you don't need to buy bonds. You will run into them. They'll tell you bonds are dumb. They'll tell you that the returns are so low and interest rates are rising. You don't want to invest in them in today's environment. These people are dead wrong, all right? Jack, tell them.
A little baby block, get that garbage out of here.
Bonds are an essential part of a portfolio. I don't care what people say. And there's a quote that I read in a book once. It goes, "You're not a wimp if you hold bonds, no matter what your friends tell you." Like I said, I am a firm believer that bonds should be part of any investor's portfolio, not only because they're a source of income, but more importantly, they act as a hedge or a buffer during a down market, okay? So when the markets go down, when the equity markets are crashing and stocks are losing a bunch of value, which will happen, right? It's not a matter of if, it's a matter of when. The stock market goes through its cycles, and at some point they will go down. That's just the nature of investing. Bonds have historically performed very well. And the reasoning behind that is that when the stock market is crashing, investors will sell their investments and they will cycle their money into a safer area like bonds or like gold, which will drive up the price. It's called flight to safety or flight to quality. So when you do have an aspect of bonds in your portfolio, it really helps with smoothing out the ride during these market declines. And investing is not about shooting the lights out 24/7. You don't want to be that guy that's making all these sweet returns in an up market, and then the market crashes and you lose 50 to 60% of your portfolio. Man, that's not cool. Don't be that guy. And that's why it's so important to have bonds in your portfolio. It's a strategy that will help you become a good long-term investor, and it's a habit that you should develop at an early age. And that's why I think that having an 80-20 asset allocation mix is the perfect mix for a millennial. So let's move on to step number 4, the most exciting part of the video. We are here, choosing your investments. All right, so let me start off this section by saying there isn't a correct way. There's not one right way to invest, but there are a lot of wrong ways to invest, all right? So you'll see a lot of people implementing different strategies or taking different routes, and that's completely fine. But with whatever route we decide to go with, one of our main concerns is achieving a good level of diversification. Now, diversification in simple terms is not putting all of your eggs in one basket, right? You want to spread your risk, you want to spread your investments amongst all the different asset classes, amongst all the different sectors, amongst multiple stocks. You never want to have all of your money invested in one area. And the reasoning behind that is that the economy or the market is constantly going through its cycles, right? And a stock or a sector that's performing very well right now, come a year down the road, it could be one of the worst performing sectors or one of the worst performing stocks. That happens all the time. So rather than trying to predict where the best place to invest your money is, a better approach is often to just diversify and make sure you're getting exposure to all the different areas of the market, invest in a bunch of different stocks. That way, as the economy grows, you'll partake in those gains and you're never going to be overexposed to a specific area. It's a really good way of mitigating your risk, and it's one of the underlying things that we have to keep in mind when we're choosing our investments. So what choices do we have? Well, the first option is to go out and buy some stocks directly, right? We can go buy some shares of Coca-Cola, Walmart, Johnson & Johnson. Pick a handful of stocks that we think are going to do well over the next coming years. Now, that's fine, all right? That's a fine option. However, I just touched on the importance of diversifying your assets. And with $1,000, you could probably get yourself, maybe 2 to 3 different stocks. And if you have all of your investments invested in 2 to 3 companies, I mean, God forbid something happens to one of those companies, the stock plummets, or even worse, the company goes bankrupt. That is a big portion of your investments that are at risk. All right, so there's a lot of concentrated risk when you're investing in stocks directly, and it's very difficult to build a good diversified portfolio when you have a smaller amount of money. And that is why, for a beginner investor with not a whole lot of money, you absolutely should be investing in a mutual fund or an ETF. And what those are, for someone who doesn't know, it's basically just a bundle of stocks or a bundle of assets. So a mutual fund is basically just a basket full of stocks. And one mutual fund may contain 100 stocks, it may contain 1,000 stocks. And when you buy units of this mutual fund or ETF, you're essentially getting access to all of these companies that you otherwise wouldn't have been able to afford. So it's a very good, viable option for a beginner. In fact, it's really the only way to get a good level of diversification when you don't have a lot of money. And just to clarify, you're still investing in these stocks. You're just investing in them through the use of a mutual fund or through the use of an ETF. And I came across an example just the other day that I really liked. It was saying that investing is it's like candy. Like, imagine you had a pack of Skittles, right? You could go and you could try to, pick out the best ones, right? Pick out the red one and the yellow one and the green one, or you could just buy the entire pack. That's what an ETF is. That's what a mutual fund is. It's like buying the entire pack. Now, let me show you an example here of a mutual fund. I'll bring it up on my screen just so that you can get a better idea. So this right here is a mutual fund. It's essentially a snapshot of a mutual fund. And in this case, we are looking at a Fidelity fund, all right? It's called the Fidelity North American Equity Fund. So Fidelity is the company that created this fund, and they're offering it to us to invest in, all right? It's one of the investment choices that we have. But this number right over here is the price of the fund. So as of today, for $11.44, you can invest in this mutual fund. And basically what you'd be doing is you'd be buying units of this fund. So we can say with your $1,000 investment, that would get you like, approximately 80 units of this fund. Now, let me scroll down here to the bottom of the page and we can have a look at the top 10 holdings in this fund. So what this is telling us is that this specific mutual fund currently invests in Alphabet, probably better known as Google, Bank of America, Microsoft, Berkshire Hathaway, Visa, restaurant brands. They're the company that owns Burger King and Domino's, Tim Hortons, Apple, Morgan Stanley, Canadian Pacific Railway, and these are just the top 10 of 55 holdings. So if you decided to invest in this mutual fund, well, you would inherently be investing in 55 companies, all with your like $12 investment. So very, very, very cool, very, very powerful investment vehicle. And again, that is something you would have not have been able to do if you were going to go out and try and buy these stocks directly, right? It would be far too expensive. There's no way that you could buy all of these stocks, for $1,000. So that was just a very quick example of a mutual fund. I just wanted to show you that how by investing in one fund, you can get access to multiple companies, right? It is a very good way of getting diversification for a very low price. Now, to tie things all together here, thinking back to the first step, if you decided to go to the bank as your broker, as your brokerage, you will very likely be investing in mutual funds, okay? That's the product that they'll have you investing in. And I'll bring back up the screen recording here. We're gonna have a look at something very important. It's called the MER, all right? Which stands for the Management Expense Ratio. And this right here, this is basically the fee that you're going to be paying to invest in this mutual fund, all right? So how it works is that if you had your $1,000 and you invested it all in this fund, every year you'd pay about $25 in fees, right? 2.5%. And that would be taken off automatically. And this is actually how the advisor would get paid, all right? So a lot of people don't know, how advisors make their money. Do they charge a separate fee? Do you pay them on the side? Well, no. Their job is to link you up with the appropriate mutual fund based on your specific goals, based on your specific objectives. And of this 2.5% fee that you're paying, they're going to get a portion of that, all right? That's how they get paid. You don't have to pay a separate fee. All of your costs are going to be included in this 2.5% MER. Now, if you decided to go with an online broker, so Questrade, then in that case, I would absolutely recommend going with an ETF. And we can recall that Questrade in particular, they offer ETF purchases at no cost. So an ETF or an exchange traded fund is very, very similar to a mutual fund, right? It's like a basket or a group of stocks or a basket of assets. And when you invest in an ETF, again, you're going to get a very good level of diversification for a very low cost, right? ETFs are very cheap. And we'll go over a couple examples in a second. But the important thing here is that when we're deciding what type of fund to buy, whether that's a mutual fund or an ETF, the important thing is that we are investing in a broad equity fund. So that would be a fund that invests primarily in stocks. And in particular, we want to aim for US and Canadian stocks, all right? Those are two of the most successful markets in the world. A lot of very successful companies, a lot of growth coming out of these two markets. So I'll show you right now a couple examples of broad equity funds. In this case, we'll look at a couple of ETFs. And like I touched on, if you decided to go with an online broker, these would be some great investments to buy. So this right here is called the Vanguard S&P 500 Index ETF. Its ticker is VFV. And in America, I believe they have a version with the ticker VOO. Now, Vanguard is one of the big providers of ETFs. So similar to the Fidelity fund that we looked at earlier, Vanguard is another company that packages up these products and we can invest in them, right? It's one of the investment choices that we have. So let me scroll down to the bottom of this page and we'll take a look at the contents of this fund. So this specific fund invests in Apple, Microsoft, Google, Amazon, Facebook, Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase, ExxonMobil, Bank of America, and these are just the top 10 of 500 holdings. So this fund basically invests in the 500 largest companies in America, and as you can imagine, that is a great way to get exposure to the US markets. Now, I can scroll down a little bit more here, and we can see the breakdown of how this fund is invested amongst the different sectors. So having a look at this, currently about 23% of this fund is invested in tech companies, 14% in financials. That would of course be the banks, the insurance companies. They're invested in healthcare, consumer discretionary, industrials. I mean, it's just truly diversified amongst all the different sectors. This is exactly how you want to invest. Now, let me scroll up to the middle of this page. We can have a look here at some of the returns for this specific ETF. So we can look here and zoom in on the performance, and these are the type of returns that you could expect by investing in this ETF. So this right here is the 1-year number. So over the past year, this fund is up or has grown by 19%. So if you were to have invested your $1,000 last year, well, by now you would have made 190 bucks. I mean, that is a great year. We can have a look beside at the 3-year numbers and the 5-year numbers. Very, very strong performance from this fund. And that is because the US market has absolutely been killing it. I mean, we can think about all the companies, Apple, Google, Facebook, very, very good companies. These stocks are performing very well, and they are all included in this ETF. Now, not to burst anybody's bubble here, but these type of results are not sustainable, all right? It's unrealistic to think that going forward, we could expect 20% returns year after year after year. Over the past few years, the markets have been very hot and they've been performing very well. So I don't want anybody getting, the false hope that this ETF is like a superhuman ETF, only goes up by 20% and it doesn't go down. Excuse me. This ETF, like any other investment, will have its bad days, it'll have its bad years, it'll go through its cycles, all right? So I think that a much more reasonable expectation as for rate of return would be right in that 7 to 9% range. That's very typical for US equities. And if you could achieve, let's say, an 8% rate of return over the next 40 years, that is a very, very respectable rate of return, right? So this ETF would fall right in that range. And you would make a lot of money over the years. And if you were to tell me right now, like, hey, I want to invest all of my money in this one ETF, VFV, I'd say go ahead. I mean, I'd probably give you the green light on that because, investing in ETFs or these broad index funds is a very, very good strategy for investing. In fact, a lot of very successful investors have majority of their money invested in an ETF like this. So like I said, if you wanted to go with this ETF as your investment choice, I'd say go ahead. However, my personal recommendation to you, especially if you decide to go with Questrade, remember where there's no commissions to purchase ETFs, right? We can buy as many as we want without worrying about commissions. I would absolutely recommend not only investing in the US market, but also investing in the Canadian market as well. And the ETF that I would recommend using for this is the iShares Core S&P TSX Capped Composite Index ETF. All right, now don't get scared off by that name. This is a great fund as well. So similar to how VFV, the Vanguard fund, that fund invested in US stocks, this fund, XIC, invests in Canadian stocks or Canadian equities. So let's have a scroll down to the bottom of this page and we can see the components of this fund. And what we're going to see is the big Canadian companies. So Royal Bank, TD Bank, Bank of Nova Scotia, Enbridge, Suncor, BMO, CIBC, Bell Canada, Manulife. All of the big Canadian companies will be included in this fund. And again, it's just another aspect of diversifying your holdings, right, between the two markets. And this would be the ETF that I would recommend investing in for your Canadian exposure. So to bring this full circle and to get towards the end of the video, I hope you guys are all still with me. Let's recall our asset allocation. All right, so we have $1,000 and we want 80% of that to be invested in stocks and 20% of that to be invested in bonds. So of that $800 that we have to invest in stocks, the investments that I would personally go with, if I was building my portfolio from scratch, is I would invest $400 in VFV, which is the US fund, and I would invest $400 in XIC, the Canadian fund. And that way our equity component is going to be broken down between the two economies or between the two markets, right? We got half in US, half invested in Canada. And I'll put in brackets here another fund with the ticker XEF. All right, this is actually another ETF that invests in international companies. So companies like Nestle and Toyota. And if that's something that interests you, what you can do is that you can invest, let's say, 10% of your portfolio into this ETF as well. So to correct myself there, what I would personally do if I was building up my portfolio from scratch is I would invest 40% into VFV, which is the American fund. I would invest 30% into the Canadian fund, XIC, and then I would throw 10% into XEF, which gives me my exposure to the international markets. And that right there would cover off the equity component of my portfolio. And by investing in these 3 ETFs, we can think about all of the names or all of the companies that we're going to be investing in. Companies like Apple and Google, Royal Bank, Amazon, TELUS, Rogers. So many great companies, so diversified. And this setup right here, you can honestly take with you to retirement. And like I said, this is exactly how I would invest if I was starting from scratch. Now, to be a little anticlimactic here, I have not forgotten about bonds. Old bonds, yes, we need them and they suck, but we need them in our portfolios. And in order to get our fixed income exposure, again, I think that we should be using an ETF. And the ETF that I would recommend in this case is CBO, which is the iShares 1 to 5 year laddered corporate bond index ETF fund. Crazy name, I know. So this ETF right here, instead of it investing in stocks like the other ones we looked at, this ETF invests in bonds, and it is a great way to get your fixed income exposure. Now I'm not going to go too in depth into this fund because bonds are honestly super lame, but you're just going to have to trust me that this is a good choice. So typically back in the day, what people would do is that they'd go out and you'd go buy bonds directly, right? You'd go out, you buy like a single bond, let's say. Well, this ETF basically invests in a group of bonds, and how it works is that their maturity dates are laddered. So some of the bonds are going to be expiring this year, then some are going to be expiring the next year, and so on and so on. And what happens is that when the bonds expire this year, that money is going to be reinvested into new 5-year bonds at the current interest rate. So it's kind of like a cycle, or it's a strategy called laddering, and it's a really good way of mitigating what we would call interest risk. So to summarize this section, those 4 investments right there, those 4 ETFs are what I would recommend to you. This right here would be your portfolio, and that to me is a very good, very well balanced, well structured portfolio. You would expect a lot of growth over the long term with these ETFs, and it's just the perfect portfolio for a millennial investor. So this is what I would run with if I were you. Now, before I end this video, there's one more step that I want to go over, because investing doesn't just stop here, right? You don't just pick your investments and you're done. In fact, things are just getting started. So let me go over a few follow-up things that will ensure that you have a successful investing future. So step number 5, follow up. First things first, sit back and relax, okay? If you decided that you want to go with this portfolio, congratulations. The most important thing here is that you have, decided that you want to start investing, you want to start putting your money away, you want to have your money growing for you. So seriously, even the fact that you've made it this far in this video, congratulations to you. But the first thing that you need to understand, especially if you're a new investor, is that you're going to need to be patient, all right? This is not going to be an overnight success. In fact, it's going to be the exact opposite, all right? Investing is very much a long-term game, and don't think that just because you bought these ETFs, you're going to make a bunch of quick money over the short term. That's not the case. As younger investors, we have a long future ahead of us with a ton of learning, right? There's going to be ups, there's going to be downs. Literally, we will see our portfolio, our investments will be growing, and then there will be periods of time where this isn't the case. It's just the nature of investing, right? It will go through its cycles. That's just why it's so important to be patient. But what we need to understand is that the way our portfolio is structured, if you go with this portfolio, you are set, you are ready for whatever the market has to throw at you. Now, the second thing that you need to do is that you need to start putting money away on a consistent basis, okay? It's not enough to just invest this $1,000 and expect that to grow into something crazy, because it won't. You need to be continuously adding to your portfolio and getting into the habit of putting money away. So I would recommend starting with $100 a month and investing it in that same ratio that we talked about. So 40% going into the American fund, 30% going into the Canadian fund, 10% in the international ETF, and then the rest going into the bond fund. And you could do that with whatever amount you decide to put away. And honestly, this right here is kind of the huge factor as to how much money you end up with down the road. It's not really, the investments. That obviously plays a part, but what it comes down to is how much money you're putting away on a consistent basis. And I guarantee you, if you start putting money away every month, it's going to build up really quick. And a point here that I kind of forgot to mention, if you want to get into individual stocks, which is what a lot of people at some point, want to get into, you absolutely can. There's nothing wrong with that. What I would personally recommend to you is, at least let your portfolio build up to a few $1,000s. You definitely want to have the base or the bulk of your investments in a diversified investment like the ETFs. And then once that's built up to a respectable amount, then you can go, experiment with a couple stocks here and there, just buy some small positions. But the core of your portfolio should absolutely be in an ETF or some sort of diversified investment. Last thing here, before we get to the end of this video, we're almost there, guys. I promise, man. I've been talking way too much today. So let's get on with this. The last thing that you need to learn to do is to rebalance your portfolio. So what I would recommend is, once a year, no sooner than that. You don't want to be rebalancing too often, but once a year, have a look at your investments and kind of see what's going on. Because what will often happen is that, let's say a year from now, your portfolio or your investments, they're going to be all out of whack, right? Depending on how the economy performed or how the different markets performed, let's assume the US market has done very well and the Canadian market has done very poorly over the next year. Well, you can take a look at your portfolio, at your asset allocation, and it could be way off, right? Your Vanguard fund, so VFV, could be like 50 or 60% of your portfolio, and the Canadian fund XIC may be like 20. So what we would do in that situation is that we would rebalance back to our asset allocation, right? Back to those targets that we set. And we would do this by selling the fund that's overweight and then just reinvesting that money back in the areas of your portfolio that have not been doing so well, that are underweight. And that's why having a good asset allocation set is so important. It helps keep you focused and helps keep you on track with your overall investment plan. And if you're an investor that's committed to keeping your portfolio on balance, you will do very well over the long term. It's very important to keep your portfolio balanced, rather than just letting your investments go crazy and just not even looking at things. And that's why rebalancing once a year is a very important step. So guys, that brings us to the end of the video. I honestly had a really good time making this video. I hope you guys enjoyed it. I hope that I was clear and informative. And most importantly, I hope that you can take this information and put it into action. If we start investing now as millennials, we can make a ton of money over the years. It's not even funny. And it's sad to see, people that are, eligible or capable of investing and they're not. They're missing out on a huge opportunity. So really, I hope that you guys can take whatever information you got from this video and just go out and start investing. That's the most important thing. So if you guys enjoyed this video, you can give it a like. That would very much be appreciated by me. If you want to learn more about investing in the stock market, you can subscribe to my YouTube channel. And of course, if you had any comments or questions about this video, about things that I missed, or questions that you have, leave them in the description below. I'd be happy to answer them. And I thank you guys for watching, and I'll see you in the next video.